So if I told you that by the year 2035, the phone in your pocket is going to be silently negotiating with cell towers, like sending up to 450% more traffic into the cloud while the screen is completely black, you'd probably think I was talking about some secret Silicon Valley startup, right?
Oh, totally. It sounds like pure sci-fi.
Exactly. But the blueprint for this massive invisible data tsunami isn't from a startup at all. It is actually buried inside the Q2 2026 earnings call of a 100-year-old telephone company.
Yeah, AT&T.
Right, AT&T. So welcome to this deep dive into the AT&T Q2 2026 source material. Our mission today is to decode how CEO John Stankey and retiring CFO Pascal Desroches are quietly building the physical plumbing for the AI revolution.
And, they're not just building the new stuff. They're finally killing off the century-old copper wire network, which is huge.
It really is. And we're even going to get into how they're preparing to beam cell service straight from space. I mean, usually corporate earnings calls can cure insomnia, but this one reads like a literal manifesto for the next decade.
It really does. And I think, just to set the stage for you listening, we're looking at a Q2 2026 snapshot of a massive legacy telecom company that is right at the tipping point of a total transformation.
Yeah, they've been through a lot of changes.
Right. If you go back to the early 2020s, AT&T was shedding all its media distractions. They spun off Time Warner. They stepped away from the entertainment business entirely.
Which was, frankly, a bit of a mess for them.
Yeah, it was a huge distraction. But they made a very distinct choice to return to pure connectivity, just fiber optic cables and 5G wireless. And now, in 2026, the financials we're looking at reveal the fully matured results of that singular focus.
Okay, let's unpack this, because before we get to the cool AI stuff and the space satellites, we really need to understand the financial engine that's funding it all.
You always have to follow the money.
Exactly. And the headline numbers here are surprisingly aggressive for a legacy telecom. I mean, we're looking at this from an investor's perspective, right? We want actionable data.
Right. The data is what matters.
So adjusted earnings per share, the EPS, hit 65 cents this quarter.
Which is up from 54 cents the prior year.
Yeah, that's over 20% year-over-year EPS growth for a telecom.
Is massive. And then you look at free cash flow, which increased by roughly $300 million year over year to hit $4.7 billion.
$4.7 billion in a single quarter.
Right. And Pascal Desroches, the outgoing CFO, pointed out that this easily exceeded the high end of their guidance range, which originally sat at $4 to $4.5 billion.
But okay, here's where I have to push back a little, or at least point out the weird discrepancy.
Go for it.
When I look at the top line, consolidated service revenues only grew 2.7%.
Yeah, 2.7%.
I mean, in any other sector, a 2.7% revenue growth rate sounds kind of boring to the average person. Why is management treating this like a massive victory lap?
Well, the disparity between that 2.7% top-line growth and the massive cash generation, it all comes down to operational efficiency.
What do you mean, like cost cutting?
Partly, but it's more about the quality of the revenue. The transcript highlights an adjusted EBITDA margin. So that's the profitability of their core operations before interest and taxes, and it expanded by 110 basis points to reach 39.1%.
Wow. So they are keeping almost 40 cents of every dollar before taxes and debt.
Exactly. That 39.1% is the highest consolidated adjusted EBITDA margin they've achieved since they pivoted back to pure connectivity at the start of the decade.
Okay, that makes sense.
Yeah, they're squeezing significantly more cash out of every dollar that comes in the door. And the reason they can do that is because the actual composition of their customer base is fundamentally changing.
Right, the story behind the numbers. Stankey spent a lot of time on this call talking about the specific type of customer they're acquiring now.
He did. The headline metric he pointed to was 147,000 consumer postpaid wireless accounts added in the quarter.
Okay, let's translate some Wall Street jargon for a second, because this is crucial for anyone holding the stock. What is the difference between adding an account and adding a line?
That is the key to understanding the margin expansion right there. A net line addition, which, by the way, they had 432,000 of those for the quarter. That often just means an existing customer added an iPad or maybe a child's first phone to their family plan.
Right, so I already have AT&T, and I just pay an extra $10 a month for my Apple Watch.
Exactly. It's incremental revenue.
Yeah.
Which is nice, but it relies on an existing relationship. It's relatively easy money.
But the 147,000 figure is different.
Very different. That represents entirely new households or individuals who are previously paying a competitor. like they were with Verizon or T-Mobile. And AT&T convinced them to switch over entirely.
Winning a new logo, a fresh account.
Yes, and winning a completely new account is the hardest, most expensive thing to do in telecom.
Because everyone already has a phone plan. You have to convince them to go through the pain of switching.
Right. So achieving their best new account addition result in over 3 years, which this 147,000 ISI, that indicates their broader market proposition is really resonating. They aren't just upselling their current base, they are taking actual market share.
And I noticed they achieved this while actually increasing their average revenue per user, or ARPU, on the wireless side.
Which is wild.
It is, because usually if you want to steal 147,000 new accounts from competitors, you have to discount heavily. You run aggressive promotions, you slash your monthly prices, and as a result, your average revenue takes a hit.
You essentially buy the customer.
Exactly. But they grew the average bill while simultaneously driving their churn rate down.
And churn, for those following subscription models, churn is the silent killer.
Absolutely. If you're losing customers as fast as you get them, you're dead in the water.
Right. When a telecom company has high churn, they are forced to spend billions on marketing and phone subsidies just to replace the people leaving the network. It's a treadmill.
So how are they keeping people from leaving while charging them more?
Stanky attributes this lower churn and higher ARPU to what he calls highly seasoned lifecycle management.
Meaning what, practically?
It means they're aggressively analyzing specific cohorts of users. They know exactly when you're likely to get frustrated or when your phone is getting old. And they target you with upgrades or tailored plans at the exact moment you might be considering a switch.
So before I can even Google Verizon deals, AT&T is offering me a sweet upgrade.
Basically, yeah. By reducing the volume of customers leaving, the marketing dollars they do spend are actually accumulating net growth. They aren't just plugging a leaky bucket anymore, they're actually filling it up.
Okay, that brings us to the big strategic play, because how are they actually locking these customers into the ecosystem so tightly that churn goes down like that? The buzzword heavily cited throughout this entire transcript is convergence.
Convergence, yeah, that's the holy grail right now.
Historically, telecom was very siloed, right? You paid your cable company for the router in your living room, and you paid a completely different cellular company for the phone in your pocket.
Right, you had Comcast for the house and AT&T for the phone.
But AT&T is actively trying to demolish that separation. They want you to buy both your home fiber internet and your mobile phone service directly from them.
And it is working. The data from the second quarter shows that 42.5% of AT&T's advanced home internet customers now hold a postpaid wireless account as well.
Nearly half.
Yes. Nearly half of their fiber base is also utilizing their cellular network. And Stanky actually noted that if you strip out the footprint of customers they recently acquired from Lumen, which we'll get to in a second, the convergence rate is actually 45%.
That is a staggering overlap. But this strategy requires a really counterintuitive approach to pricing, which the CFO, Pascal Desjoshes, openly admitted on the call.
He did.
Because their fiber ARPU, the average amount they make on home internet, actually declined by 1.3% compared to a year ago.
And Wall Street traditionally hates that. They punish companies for losing pricing power on their core growth product.
Right. If your futuristic fiber product is making less money per user, investors usually panic. But honestly, it reminds me of the Costco rotisserie chicken model.
Oh, the chicken model. Explain that for the listeners.
So Costco famously takes a loss on their $4.99 rotisserie chicken. They place it all the way at the back of the massive warehouse store because the lifetime value of the shopper who has to walk past the big screen TVs and the jewelry just to get that cheap chicken is astronomically high.
They lose money on the chicken to make it back on the television.
Exactly. And AT&T seems to be actively suppressing their fiber margins to run this exact same play. Fiber is the chicken.
That is a brilliant analogy. And Desjoshes has basically confirmed that underlying dynamic on the call. He stated that excluding the newly acquired Lumen footprint, fiber ARPU was approximately flat year over year.
So they aren't pushing price hikes there.
No, they are intentionally offering discounted pricing on the home fiber to incentivize converged customer accounts. The financial logic is entirely based on lifetime value, or LTV.
LTV is everything here.
Right. When a household binds both its primary internet gateway and its mobile communications to a single provider, the friction required to switch becomes overwhelming.
Oh, I can imagine. Trying to untangle your phone plan and your home internet at the same time, nobody wants to deal with that on a Saturday.
Nobody. So the customer stays longer, their overall household spend actually increases over time, and the operational cost for AT&T to service that single unified account is lower than servicing two separate ones.
And Stankey vehemently defended this approach during the Q&A portion of the call when an analyst asked about the pressure on broadband revenue.
Yeah, he was pretty firm on that.
He made it clear he doesn't want his team siloed, worrying about maximizing the margin on one specific product, like just broadband. If using broadband as a loss leader or even just a margin leader consolidates an account and secures a highly profitable long-term wireless relationship, he views that as a massive strategic win.
He is optimizing for total household wallet share, not product-level margins.
Exactly, but to scale that convergence model, they need raw geographic footprint. They need more homes to offer fiber to, which is why the Lumen acquisition is such a huge focal point in this transcript.
Yeah, let's talk about Lumen, because this is a big deal for their expansion. AT&T acquired a fiber asset footprint covering over 4 million locations from Lumen Technologies.
4 million locations is huge.
It is, but integrating a physical asset of that size is a nightmare. It requires standardizing the entire technical architecture.
Because it's a completely different company's network.
Right. Stankey outlined how they spent 6 entire months just establishing operations in the new territory. They had to port over the billing systems, they had to retrain the field technicians to AT&T standards, and they had to deploy AT&T's specific customer premises equipment, the actual routers and gateways that go inside the homes.
It's a massive logistical heavy lift, but the speed of that integration is really visible in their June metrics. Stankey pointed out that converged gross additions in these newly acquired Lumen territories were up 45% compared to February.
A 45% jump in just 4 months.
Yeah. In 4 months, they took a newly absorbed market, applied that discounted Costco chicken fiber strategy, and nearly doubled their rate of locking in converged households.
It proves the model works.
It suggests their playbook is highly replicable across underpenetrated geographies. As an investor, you have to look at that and see a scalable growth engine.
It really creates a self-reinforcing cycle. Because as they establish the AT&T brand in these new markets and normalize the service delivery, Stankey anticipates putting even more resources behind it to drive those volumes higher.
But, and this is a big but, the massive capital expenditure required to lay dense fiber and acquire 4 million locations isn't just about selling a bundle today.
No, it's not.
The engineering philosophy discussed in this transcript reveals that they are bracing for a fundamental shift in how the internet actually operates.
This is where the call gets really fascinating.
This is where it reads like a technical manifesto. John Stankey dedicated a huge portion of his prepared remarks to agentic AI, and specifically how agentic AI reshapes the actual physical requirements of a telecom network.
And we really have to separate the AI we use today from what AT&T is building for.
Right, because right now, AI is largely passive. You or I type a prompt into a browser like ChatGPT, we wait a few seconds, and we receive text back.
It's basically a glorified search engine interaction at this point.
Exactly, but agentic AI is totally autonomous. You assign it a high-level goal like negotiate a vendor contract for my business or organize a complex multi-city travel itinerary, and the software agent navigates the web on its own. It interacts with APIs, it talks to other AI agents, all without any human intervention.
And the distinction for a telecom company lies in the sheer volume of background compute that requires. Stankey cited some industry research indicating that AI agents generate up to 450% more total traffic per task than a human performing the equivalent work.
450%?
Yes. Because think about it. When a human books a flight, our biological bottleneck limits the data consumption. You read the screen, you deliberate over the price, you click the mouse slowly. The data being exchanged is primarily just lightweight HTML.
I take 10 minutes just to decide if I want the aisle or window seat.
Right, exactly. But an AI agent operates without that friction. It can simultaneously query 50 different airline databases, cross-reference historical pricing models in real time, ping calendar APIs, and negotiate with hotel software agents, executing thousands of concurrent data requests in literal milliseconds.
So that 450% increase, compounding across the entire economy, leads to these wild projections Stanky laid out for 2035. He's projecting a 9x growth in enterprise traffic and a 7x growth in consumer traffic.
It's an astronomical amount of data.
But it isn't just a volume problem, right? Stanky heavily emphasized a shift in network symmetry.
Yes, symmetry is the key technical hurdle here.
Historically, consumer networks have been deeply asymmetrical. We download gigabytes of 4K video from Netflix, but we only upload tiny text requests or button clicks. So the downlink capacity of the network dwarfs the uplink capacity.
Right, the pipes are built huge going into your house, but very small going out.
Exactly. So how does agentic AI flip that architecture?
Well, autonomous systems, whether it's a fleet of self-driving vehicles, delivery drones, or even augmented reality hardware, they rely on edge computing. The device isn't just receiving instructions from the cloud, it is constantly generating massive amounts of environmental data.
Like cameras and sensors.
Exactly. LiDAR, high-definition video feeds, and sensor telemetry must be uploaded to the cloud or an edge compute node for instant inference. Stanky noted the network must sense, decide, and act in near real time. If the uplink is congested, the autonomous system fails.
Self-driving car crashes.
Right. The network must become symmetrical. It has to be capable of handling just as much data flowing out of the device as flowing into it.
But here's where it gets really interesting, kind of a paradox. If AI is just doing the thinking for us, shouldn't we be looking at our screens less, meaning less data?
I think so, yeah. Actual human screen time will likely decrease. We won't be staring at booking websites for hours.
Yeah.
But the device's data consumption will skyrocket because it maintains a persistent high bandwidth dialogue with the cloud.
So even when the screen is black and my phone is just sitting in my pocket, the background compute is relentless.
Relentless.
Yeah.
And managing that persistent background compute requires a density of infrastructure that current macro cell towers simply cannot support.
Because a traditional macro tower radiates a signal over a wide geographic radius, right? Like miles.
Right. But it quickly becomes a bottleneck if tens of thousands of autonomous agents and vehicles in that radius are simultaneously uploading gigabytes of data. It just gets jammed up.
So what's AT&T's solution?
Stanky's solution relies heavily on PON-fed small cell infrastructure.
Let's break that jargon down. What is PON?
PON stands for a passive optical network. Essentially, they're utilizing their deep underground fiber lines to feed localized microantennas. They place these tiny cell towers on light poles, the sides of buildings, street corners.
So instead of one giant tower far away, you have hundreds of tiny towers right next to you.
Yes. By pushing the radiating point of the network closer to the end device, they completely bypass the congestion of the macro tower. And Stanky pointed out that their massive fiber footprint, the stuff we talked about with convergence, is the foundational asset that makes this density possible.
Because you can't deploy a small cell without a high-capacity fiber line acting as the backhaul to carry that data back to the core network. You need the physical wire in the ground first.
Exactly. The wireless network is actually just a fiber network with a very short wireless jump at the very end.
That's a great way to put it. And he also highlighted the critical role of specific spectrum frequencies, particularly low-band spectrum, like the 600 megahertz band.
Yeah, spectrum is the invisible real estate of telecom.
Right. And in radio frequency engineering, lower frequencies travel further and penetrate physical obstacles like concrete and steel far better than high-frequency millimeter wave spectrum.
Millimeter wave is super fast, but a leaf can block it.
Exactly. So Stanky views this low-band spectrum as absolutely essential for engineering a robust upstream network. It ensures that an AI agent operating inside a dense office building behind layers of concrete maintains the consistent low-latency connection required to execute tasks without dropping the session.
And Stanky genuinely believed this combination of interconnected metro fiber and deep spectrum creates an unassailable physical moat for the company. I mean, he literally stated, "I wouldn't trade our assets for anyone else's," anticipating they will operate the most advanced communications network in the US by the end of the decade.
That is some serious CEO swagger right there.
It is. But constructing this hyperdense symmetrical architecture requires relentless capital deployment. I mean, billions and billions of dollars. And running two parallel networks, the future-proof fiber and the century-old copper wiring, is financially ruinous.
You can't pay for the future if you're constantly fixing the past. To afford the AI-ready fiber future, AT&T has to ruthlessly cut the dead weight. Enter the death of copper.
The copper network is a massive operational anchor.
And the financial drag is incredibly explicit in this quarter's numbers. Get this. Legacy service revenues plummeted 26% year over year.
Wow.
And the EBITDA on that legacy business dropped 46%. It is a rapidly dying business. It's a decaying asset as consumers finally abandon copper landlines and obsolete DSL internet.
Yeah, nobody uses DSL anymore. But here's the catch. Telecommunications regulations historically designated carriers like AT&T as a carrier of last resort.
Which means what, exactly?
It meant they were legally mandated by the government to maintain the physical copper infrastructure, repair down poles, and power the massive switching centers, even if a geographic area only had like a handful of remaining legacy customers.
So they were forced to lose money maintaining empty networks.
Precise.
But we are finally seeing the regulatory framework acknowledge the decay of this infrastructure. Stankey specifically acknowledged FCC Chairman Brendan Carr on the call for facilitating the modernization of the network.
Which is a big deal. The FCC recently granted AT&T the authority to discontinue legacy copper voice service in approximately 60% of their wire centers in California.
California is a massive market, so that's a huge victory.
It is, and nationwide. They have secured approval to sunset these services in over 30% of their wire centers by late 2026.
So this regulatory green light triggers a financial mechanism management refers to as descaling.
Descaling. Let's explain what a wire center actually is, because it's wild to think about.
Yeah, please do.
A wire center is the physical building where all the neighborhood copper lines converge into massive, power-intensive switching equipment. Stankey anticipates that by the end of this year, a couple hundred of these entire wire centers will have absolutely zero customers utilizing legacy services.
It's like paying the heating bill for a 50-room mansion when you only live in one bedroom. And they're finally legally allowed to turn off the radiators in the empty rooms.
That's exactly it. Once the final legacy customers migrated off the copper, the descaling process begins. They can physically rip out the legacy switches, which drastically cuts their energy consumption and maintenance overhead.
They save a fortune on electricity alone.
Oh, massive amounts. And in many cases, because modern fiber routing equipment is a fraction of the size of the old copper switches, they can consolidate the hardware into a tiny closet and actually sell off the underlying real estate.
Because they own these prime buildings in the middle of cities.
Right. So Stankey reflected on a promise he made 2 years ago to establish a path for an orderly turndown of legacy copper by the end of the decade. And his assessment on this call was very definitive. He said, quote, "In my view, we've now reached the tipping point, and that goal is firmly in sight."
Stripping away the maintenance costs of a dying network frees up billions in capital and operational bandwidth. And they can redirect all of that strictly toward the AI-ready fiber and 5G deployment.
Which they desperately need to do to hit those 2035 projections.
Okay, so the urban and suburban environments will be blanketed by this dense small cell network. Copper is gone. But Stankey also addressed a major vulnerability. What happens when you physically unplug and leave the terrestrial grid?
Ah, the corner cases.
Right. If you are hiking in a remote canyon or offshore on a boat, the capacity of the metro fiber network is completely irrelevant. You fall into what Stankey calls the corner cases, which he estimates account for roughly 2% of a customer's time or traffic.
Only 2%, but it's a critical 2%. That gap represents a significant strategic vulnerability because the lack of connectivity in an emergency is a highly emotional event for the consumer.
If your car breaks down in a dead zone, you don't care about fiber backhaul, you just want to call a tow truck.
Exactly. And this tension was really highlighted during the Q&A portion of the call when analyst Craig Moffett pressed Stankey on the intense industry speculation regarding low Earth orbit satellite providers, specifically Elon Musk's Starlink.
That was a spicy exchange.
It was. Moffett inquired if AT&T would consider utilizing a constellation like Starlink through an MVNO, a mobile virtual network operator agreement, to plug these coverage holes or even compete in fixed wireless access.
An MVNO is basically when you rent space on someone else's network and slap your brand on it, right? Like Mint Mobile does with T-Mobile.
Exactly. And Stankey completely firmly rejected the premise of relying on a competitor for their core network capacity. It was a real alpha response.
He was having none of it.
None of it. He laid out his framework for wholesale agreements, stating the motivation for a wholesale arrangement is always to get on a part of the market that you can't get at yourself. But AT&T natively owns and operates 98% of its traffic.
They control the physical infrastructure, the billing, the local technician workforce, everything.
Right. So Stankey summarized his position by saying, quote, "I'm not prone to look for a wholesale agreement to go solve a problem I don't have."
Boom, drop the mic. But while he dismissed leaning on Starlink for primary broadband, he immediately pivoted. He added, "I am prone to look for a partnership to solve the 2%.
Because the 2% is a real problem.
Right. So AT&T's actual solution to those dead zones is a deep integration with a partner called AST Space Mobile. The goal is to provide a seamless, direct-to-device satellite offering, which Stanky expects to be fully functional by 2027.
And we have to explain the technical mechanics of direct-to-device, because that's what makes this viable for a mass consumer base.
Yeah, how does it actually work?
Well, historically, satellite internet required you to mount a specialized dish to your vehicle, or you had to carry a heavy, clunky satellite phone with a massive external antenna.
Like in a 90s action movie.
Exactly. But with AST Space Mobile, those satellites essentially function as low Earth orbit macro cell towers in space. When your standard, everyday smartphone loses terrestrial 5G coverage, the network architecture is designed to automatically route your traffic through the satellite constellation.
So I don't need a new phone. I don't need a dish.
No special equipment at all. Your regular phone will just seamlessly connect to a satellite. The customer experience remains entirely unchanged.
That is the ultimate form of network assurance. If AT&T can guarantee that a customer's standard device will maintain connectivity unconditionally, regardless of how geographically isolated they are, it establishes a formidable defense against churn.
Nobody would ever leave.
Right. Achieving this by 2027 would effectively close the loop on their physical infrastructure map.
But again, executing on all of this fiber convergence, small cell density, replacing copper, and space-based routing requires an immense capital structure.
Which brings us back to the outgoing CFO, Pascal Desroches. As he prepares to retire, his final moves detailed on this call revolve around securing the specific wireless spectrum required for the next decade, while simultaneously aggressively returning cash to you, the shareholders.
Right, because we know they're projecting over $18 billion in free cash flow for the year.
$18 billion, that's a massive war chest.
It is, and the capital allocation strategy here is remarkably stark. Between dividend payouts and share repurchases, management is returning approximately $18 billion to shareholders this year.
Wait, so they are distributing essentially 100% of their expected free cash flow right back to the owners?
Almost exactly 100%. They actively pulled forward their share repurchases, increasing the target by 25% to roughly $10 billion for the year.
During the call, Stanky was incredibly blunt about his rationale for the buybacks. He stated there is a clear disparity between the underlying operational momentum of the company and the market's current valuation of the stock.
He thinks Wall Street is undervaluing them.
Heavily. He views the stock as suppressed, making aggressive repurchases the most logical use of excess capital. If you think your own stock is cheap, you buy it up.
But they didn't just spend cash on stock. They also deployed capital in the secondary spectrum market to bypass a massive regulatory roadblock.
Let's get into this spectrum chess game because it's a highly technical but vital point for their future.
Okay, so to provide the bandwidth necessary for agentic AI, telecoms rely heavily on mid-band spectrum. It offers the ideal balance of high data capacity and reasonable geographic propagation.
It's the Goldilocks zone of wireless spectrum.
Exactly. Now, the FCC had planned to auction off a vital block of this known as the upper C-band. But as noted in the call, that spectrum will be completely undeployable until 2031 due to delays.
2031. Waiting until 2031 for critical network capacity isn't an option when AI data demands are compounding annually.
Not at all. Stanky actually criticized the 4 years of inactivity on public policy regarding spectrum, noting that lost time cannot be easily recovered.
So how do they bypass the FCC roadblock?
AT&T executed a private transaction. They acquired spectrum licenses directly from EchoStar, and they closed that deal in July.
So they just bought it on the secondary market?
Yes. But acquiring that spectrum requires taking on debt, which temporarily alters their financial profile. Desroches walked the analysts through the leverage mechanics.
How bad is the debt hit?
Well, AT&T's net debt to adjusted EBITDA ratio, which is the main metric used to gauge a company's ability to pay off its debt, currently sits at 2.68x against a long-term target of 2.5x. Funding this EchoStar acquisition will push that leverage ratio up to the 3.2x range.
Oh, that's a pretty significant jump in leverage.
It is, but management is taking a calculated short-term hit to their debt profile because they understand that without the mid-band spectrum, the network bottlenecks and the AI future stalls.
And Desroches assured the market that their cash generation is robust enough to deleverage back to the 2.5x target within approximately 3 years, right?
Yes. They are utilizing their balance sheet to guarantee their physical capacity for the AI transition. They're securing the real estate now.
It's a bold move, and it is within this environment of secured spectrum, record margins, and massive cash generation that Pascal Desroches is passing the CFO torch to Jennifer Byery.
And Stanky's commentary on Beery's background is highly indicative of the company's trajectory. He emphasized her deep understanding of the fundamentals of running a software-driven enterprise.
Framing AT&T as a software-driven enterprise is a profound departure from the legacy identity of a company stringing copper wires on wooden poles.
It's a total paradigm shift. The physical fiber in the ground and the cell towers are merely the sterile hardware now.
Right. The actual value is generated by the software-defined networking that intelligently routes autonomous data traffic, manages spectrum allocation on the fly, and integrates space-based nodes seamlessly into terrestrial pathways.
So as an investor, what's the bottom line here? Bullish or bearish?
I mean, you have to look at the whole picture we just painted. We are looking at a company that is intentionally cannibalizing short-term product margins, the Costco chicken, to achieve absolute household convergence.
Right, they're trading ARPU for lifetime loyalty.
Exactly. They are ruthlessly descaling a century-old physical asset in the copper network, and they are engineering an uplink-heavy architecture to support a 450% expansion in machine-to-machine traffic.
They are entirely restructuring the physics of their network. It's incredibly bullish for their operational efficiency and their competitive moat.
I agree. So what does this all mean for you, the listener, beyond just holding the stock?
Here is a final thought to mull over. If the underlying infrastructure is being optimized for autonomous machines that consume data at speeds and volumes entirely beyond human capacity, it forces us to reconsider the nature of the consumer relationship itself.
How so?
Right now, a user selects a static data plan based on rough estimates of human consumption. You buy the unlimited plan or the 10 gig plan.
Yeah, flat monthly rate.
But an agentic AI understands its exact bandwidth requirements down to the byte. It calculates latency requirements in milliseconds based on the specific task it is executing in the background.
So the logical endpoint of a software-driven telecom network interfacing with autonomous software agents isn't a monthly consumer bill.
Wow. Okay, where are you going with this?
It is the real-time algorithmic negotiation of microcontracts. Picture a world where your personal AI agent purchases fractions of a cent of high-priority uplink spectrum from AT&T's network only for the exact milliseconds it requires to navigate an intersection in your self-driving car, and then it immediately downgrades your service the moment the vehicle is parked.
That is, wow, that completely upends the telecom business model.
Will we even buy our own phone plans in 2035, or will our AI agents just barter for spectrum in the background? It's something to think about as you watch this company lay the physical groundwork today.
That's a fascinating thought.
And with that, we want to thank you for joining us on this deep dive into AT&T's blueprint for the future. Keep watching the margins, keep watching the convergence, and we'll see you on the next deep dive.